Welcome to my version of how to get the bank to say yes. In one of my past lives, or some of them really, I've been responsible for borrowing money for various purposes, hundreds of thousands to tens of millions, facilitating growth and turnaround, both of those. Back then, I used to think the world was simple. All I had to do was knock up a forecast, show the plan worked and show it to the bank, and the bank would just cough up and there the money would be. Then I made a bit of a mistake. I once told somebody that borrowing money was easy. I forgot to add, if you have a good plan. And unfortunately, that person heard me say quickly instead of easy. Turned out that they'd already borrowed up to the limit of their ability. And so we parted company, and I learned how not to open my big mouth. And here I am opening my big mouth again. More recently, I've come to realize that actually lenders are selling a product and borrowers are buying, and really to do a deal, you're just matching the right buyer with the right seller. Oops, sorry. So my purpose today really is to give you some tips on how to secure the best deal when you're looking for finance. First of all, I hope to help you understand the market you're dealing in. And to do this, I think it's worth looking at the lender's objectives, what they're trying to achieve, and how they might conflict with each other. And then just kind of explain the types of lender that there are in the market and the products that they offer, before moving on to looking at how to be a credible borrower, and then finally how to secure the best deal. So when you're lending money, you've got three main concerns. Lend as much as you can, make sure you get it back, and maximize the interest you earn. So these aren't rocket science, but equally it doesn't take a genius to understand that sometimes these are in conflict. You could attract a lot of customers by charging a low interest rate, but if they don't pay you back, you end up worse off than you started. It might have been better that you charge a higher rate but attracted fewer customers. Similarly, you might lend all your money at a high rate but have a high default rate, leaving you worse off because none of them pay you back than had you lent to good customers at a low interest rate. So just by way of further illustration, here are some examples. So in each case, the lender starts with £1 million and they end the year with £1,020,000. So scenario 2, easy, 2% interest, all of it lent out, all of it back, and they get their 20,000 extra at the end of the year. Scenario 2, the interest rate's a bit higher, so they don't lend as much. They only lend 2/3 of it, and they still end up with only £1,020,000 at the end of the year. Scenario 3 is a bit more realistic, so it's 3% interest rate again. They only lend 90% of it, but they get a default rate of 0.75%, so they only get 99.25 back. Again, the answer is £1,020,000. Scenario 4, you probably read them all by now, but that's 4%, a higher default rate of 1 3/4 roughly, 90% lent. Again, the outcome is the same. And finally, lending to high-risk lenders, high-risk borrowers at 20% interest, so credit card rates, but get a high default rate of 15% on yearly, you still end up with 20%. So these are rather simplified examples, and security and other things come into play, but it just serves to illustrate that lending is about balancing your objectives if you want to ensure that you as a lender want to make some profit. So when you're there as a lender, you need your capital to be working for you. You end up assessing the risk across a portfolio of customers. So as a borrower, you think, oh, it's just the risk of me, but it's not. It's the risk of their portfolio. You have to balance as a lender the risk of lending against the reward, and you aim to achieve your target earnings. And then you set lending criteria to help you protect your capital. Effectively, you're like a bookie, really. You take a few risks here and a few risks there within the portfolio, but overall, you don't risk ever losing any money. You always protect yourself. And this is how you end up with products being defined in the market. So turning to the types of lender, there are really three tiers of lending. There's tier one, which is prime lending. So they're the people you want to borrow from, the cheapest ones. Tier two, mid-market, and tier three lenders who might, in a different world, be described as loan sharks. So if you want to attract a tier one lender, you need an impeccable credit history. You have to have a highly credible proposition. You need to be clearly able to demonstrate that you can afford the repayments of whatever you're borrowing. And you need good quality security, or high quality security, really. For a tier two lender, it's more about just a sound credit history will do the job, a credible proposition, and some security. Tier three lenders will take people with a poor credit history, some very poor credit histories I've seen. It's about security, personal guarantees, and the specialist circumstances that they're lending in. So it might be in a specific type of property or lending against a particular business type. So I don't know, recruitment company, something like that. I've got one. So that's kind of lenders, and then it's really the rates you pay. The higher, the lower the tier. If you like, tier one will be cheaper than tier two, will be cheaper than tier three. So, and all this ends up with, you know, products, and it's worth understanding these products. In the B2B market, there are really 7 product lines split into 2 categories. So there are property products and there are working capital products. And property products are split into short-term and long-term. Short-term bridging finance, property development finance, longer-term commercial business mortgages, buy-to-let mortgages. So, and then in working capital, you have asset and lease finance, general business loans, which tend to be called cash flow lending. When you hear that expression, that's what it means, and factoring and invoice discounting. So each product has its own characteristics, and really probably be a presentation in its own right. But for this purpose, all you really need to understand is that there are different products and that they're managed by different teams within the bank or funders. And that when you're looking for funding, the trick to find it is to find the right person, the right product that matches most closely the requirement you have. And the right funder who's interested in that sector, because you want them to be interested in lending to you. So whichever tier of borrower you're looking at, you need to be credible, really. And in order to be credible, you need to demonstrate that what you're borrowing is affordable, that you can make the repayments with room to spare. So some lenders will quite happily take your last 6 bank statements or 3 months bank statements and look at the fact that you've got 3 times as much income coming in each month as they need a repayment to be, and lend on that basis. I often think that actually it helps you more as well to produce a cash flow forecast that shows that you can continue to generate that level of cash and that you can continue to repay at a level that clearly more than covers the amount they owe you. You need to show that you're clear in your purpose, that you've thought through your plans, and that the funds you're using are what they're going to be used for. You know, a lot of people, I think of them as a Radio 4 complainer who will go, oh, well, I just need money because I've borrowed money from this bank for ages and, you know, it's just good and I kind of need it, so why won't my bank lend it to me? It's not an overly attractive proposition, really. I need money, so therefore you should lend it to me. You need to have something more positive, a more positive outcome, even if it's we will never need to borrow money again, is a better outcome than saying, oh, I don't know whether I'm going to pay it back. So you need to demonstrate that you understand your own business as well, that you understand how it makes money. I know that sounds a bit silly, but a lot of people don't understand how their business makes money. They just make money and they do what they do, and it turns out to make money. An awful lot of people in the plant hire business, for example, don't actually understand how the prices they charge relate to the cost of the equipment they're hiring out. It's just the market rate. That's what they do. And when you come to borrow money, that makes it difficult if you're trying to buy more plant. You need to understand the key ratios of your business. You need to understand the relationship between income and costs, as I've said, the fixed, variable, semi-fixed, all that kind of stuff, and your model for success. It's so much better to be able to explain all of that than just say it just works. Have an achievable plan, demonstrate your plan's achievable, explain why it's achievable, and then again, external evidence is always good. Make it supportable and show your belief in your plan. Now, it's easy to say, I believe in my plan, this is all fine and dandy, but banks tend to want a little bit more than that. So expect to be asked to have something to risk, what are you going to lose? And often this means putting money in yourself. So in simple terms, if you're buying a piece of plant, you'll be asked to put a 20% deposit down, or commercial property, a 30% deposit down. That's not just about the bank mitigating their risk. It's also about knowing if it goes horribly wrong, you will also lose. You've got skin in the game, to use the horrible expression that bankers like to use. So now I turn to my tips really on how to secure the best deal. First of all, I ought to explain that I'm not talking about the best deal in the market. I'm talking about the best deal available to you given your circumstances and your risk profile. You may want to get 1% interest rate and the kind of money that people with loads of money can borrow at really cheap, ridiculous rates, or even minus 0.5%, whatever the base rate is at the moment. But if you're a new startup business and you haven't got any credibility, you're going to end up talking to a tier 3 lender, and you're going to end up borrowing at the kind of credit card rates of 20% a year. So tip number 1 is prepare a high quality information memorandum. Using pictures, graphs, anything you can that shows how your presentation works. It reinforces that you've thought through your plans, that you can afford the funding. And this doesn't have to be a long 5,000 page document. 2 pages will do if that's all it takes to convince people that your business works, but make it glossy, make it a sales document. Be credible. There's no point in going over what I said in the last slide, but it's really important that even if you're a relatively high risk, you can still be very credible. And perhaps my favorite tip really is to ask lenders to bid for your business. If you were going out buying widgets, you wouldn't say, oh, I'll go to the first widget supplier and buy them from them. You would go out and you would say, hello, Mr. Several widget suppliers, I need to buy these. Can you quote me some prices? And they would give you them. Banks are just the same. So there was a businessman who wanted to start up a new serviced office in Leicester. And he went along to his bank and said, can you lend me the money for this? And the bank said, yes, we'll do it. I think it was base plus 4%. That was quite expensive. So he took a bit of time and he put an information memorandum together. He had lots of glossy pictures and mock-ups of how those serviced offices were going to look busy and how exciting it was going to be, and really sold it to people. And he went along to 5 different high street banks and actually sold it to all of them and got them all to bid for his business. And in the end, the rate he was given was base plus 2%, which, if you think about it, is a massive saving on the amount of time. And he got it from his existing bank. So it's not always the first rate they give you that's the one that you want, that you're going to get. It is important not to hide any issues that you have with your business. Face up to them. I was chatting to an underwriter at Shawbrook Bank the other day, and he said the worst thing that can happen in relation to getting a deal through is if he asks a question and identifies a piece of information or a problem that nobody else has put on the bid, raised before. It raises questions over the whole of the proposition and makes it far less likely that he's going to fund the deal. You don't want to be on the back foot. Face up to your issues, show how they've been solved, make sure that people understand that it's not going to happen again and you've dealt with them. And finally, stress test your plan. Make sure that you know there's a level of comfort in it. You know what happens when things don't quite come out as you expect them to. You know, if sales don't achieve what you're going to achieve, or costs are a little bit higher, that kind of thing. Show that you can still afford it. That way, whenever anyone asks you a what if type question, then you won't be knocked off your stride. So again, I think these are all, I hope these are all good tips of good things to do. It's time, it takes, you know, doesn't have to cost money, but it does cost time, but it makes you much more credible and in a much better place to get the best deal you can for you. And really, it's, remember, you're the buyer, you're not begging. So then my final tip really is to use Egopetram. What a surprise, eh? We tend to charge a commitment fee of £495 when somebody signs up to use us, just so they don't go off and use 16 different brokers for nothing. What we're offering members of South Herts Business Network is to waive that fee if it's for your business. And equally, if you introduce somebody to us, then we'll share the fee with you and pay you £100 once they've paid it. So that's it. It's probably a lot less than half an hour, and that's a general kind of slide overview of where we're at and what we offer. Thank you for watching this presentation. I hope you found it useful.